Everyone, this is Justin Kraus. Thank you very much for joining us this evening. Tonight's presentation will be on Social Security. Topics will include, amongst other things, understanding the key risk in retirement, the fundamentals of Social Security, the 5 things you need to know, including longevity in retirement, inflation, markets, taxes, and income, and how all of those can impact you as you enter retirement. Now, joining us tonight to present on this topic will be Bill Cass with Putnam Investments. Mr. Cass is a Director of Wealth Management Programs at Putnam. In this role, he is responsible for developing and delivering wealth management-related content, educational programs, and marketing initiatives. Mr. Cass speaks regularly throughout the country to groups of financial advisors and investors on a wide range of financial planning topics, focusing on areas such as effective retirement income strategies, tax legislation developments, personal risk management, and efficient wealth transfer. Now, without further ado, I'd like to bring on Mr. Cass, and thank you once again for everyone joining us and participating in the webinar tonight. And with that, now I'll bring on Mr. Cass to present the topic.
Justin, thanks so much. Thanks for everyone for joining us either live or if you're listening to the recording, which will be available. Pleased to be here tonight and join you from Boston, Massachusetts, where Putnam is headquartered. I know everybody's out there in the Maryland, Virginia area, so thanks again. And hopefully tonight you will come out of this session with a better understanding of your Social Security benefits. Social Security is very complex. There's over 2,000 rules in the Social Security guidebook, and we're certainly not going to cover all that tonight, because we'll certainly be respectful of your time, but hopefully have you leave with some a better understanding and some high-level thoughts on how to make the right decision for accessing your benefits. It's critically important, too. In fact, for 2/3 of Social Security recipients currently, for 2/3 of them, they're getting more than 50% of their retirement income from Social Security. So that's obviously a large percentage. So it's so important that people make the right decision in how to access benefits to maximize it. And as you'll see as we continue in our discussion, and we will open it up for questions at the end, by the way, that in more instances than not, people make the wrong decision, unfortunately. So that's a little preface for our conversation tonight. Here are the areas I want to cover. The first thing I'm going to do is we're going to talk about, just in the front end, the key risks in retirement. So we'll start off there. And then we're going to tie that into Social Security and the fundamentals and how actually Social Security actually addresses all those key risks in one way or another. And then lastly, and probably most importantly, we're going to boil it down to, what are 5 things you need to know? Just right off the bat. And you're going to have to do more research on your personal situation, but this will at least give you some ideas on how to kind of attack this puzzle. So with the risks and longevity, the first risk, and that's the big one, right? We just don't know. We just can't plan on how long we're going to be on this earth, as much as we'd like to sometimes. That's the big unknown. One of the stats that I like to quote is if a husband and wife get to age 65, basically one of them is going to live in their 90s. There's a more than 50% chance one is going to live in their 90s. So talking about 25, 30 years in retirement is certainly not out of the ordinary as longevity and life expectancy has improved. The next one, inflation. And with that longer time in retirement, inflation makes a difference, right? And if you look at, we have an example here. Let's say that you're basically relying on $50,000 in income in retirement each year. After 30 years of retirement, even at a very low rate of inflation of 2% annually, you would have to be earning over $90,000 just to keep up with that pace. So even low amounts of inflation can make a difference over a long period of time. Markets. This is a big one as well, market risk. So I'll take you through this example. We talk about something called sequence of returns risks, meaning that when you retire, how is the market performing? Makes a big difference on your future of your retirement. So let's just take a hypothetical example here. Let's say you have $1 million at retirement. That's your 401k, for example. You're gonna live on that in retirement. And you take out 5% annually, and you're going to increase that a little bit each year to keep up with inflation. And you're going to invest it in a hypothetical portfolio of 60% stocks, 30% bonds, and 10% cash. Now, let's say that you retire in the beginning of 1980. Now, let's fast forward 10 years, okay? If you retired in 1980, going back in history and looking at what would have happened, you would have gotten all of that income, your 5% a year, and your portfolio would have grown from $1 million to over $1.7 million. You're in really good shape. Same thing with retiring in 1990. Again, you were taking 5% out a year, but over those 10 years, the market did well, and you actually grew that portfolio to over $1.8 million. So even better. Now look at the lucky ones who retired in 2000. Right? You got your income, your 5% each year, but at the end of that 10-year period, your $1 million is now down to $472,000. So it really affects the next 10 years, the next 20 years. You're maybe not looking so good. So sequence of returns risk and market risk can be a big impact. Our favorite topic, taxes, of course. Similar example here. Looking at 20, 30, and 40 years if you're following along here on the web. Now, we have a hypothetical portfolio again, 60% stocks, 40% bonds and cash. Again, we're withdrawing 5% each year. So, and this is going back, in this example, we're going back into 1926, and we're looking at market averages for bonds and stocks. So if you were withdrawing that much out of that type of portfolio, 96% of the time at the end of 20 years, you would have still had money left, meaning you wouldn't have run out of money. 30 years, 75% success rate, and so on and so forth. Obviously, 40 years, the numbers go down a little bit. But look at what happens if you take out 25% just to deal with taxes. Those numbers go down significantly. So taxes in retirement obviously have a big effect. Income, and specifically guaranteed income, is a big factor as well. With more people today, except if maybe you're a federal employee or a municipal employee, or if you work in a union, for most people, you don't have guaranteed income in retirement other than Social Security. You're relying on your 401k. So, again, in a similar example, over 30 years, if you're taking out 5% on a balanced portfolio, roughly 70% of the time, if you drew down that portfolio of 5% a year, roughly 70% of the time, that portfolio would have succeeded. Not bad, but now let's say you take 25% of that nest egg and you go out and purchase guaranteed income in our example, and the number goes up dramatically. Obviously, if you purchase guaranteed income, you're giving up some upside. But the point is, guaranteed income can be very, very important for many people in retirement. So let's wrap that discussion up, right? Social Security addresses all of these risks. Longevity, it's lifetime income for the worker and the spouse and the survivor, right? Inflation, there's regular cost of living adjustments. Markets, Social Security benefits have nothing to do with what's going on in the markets. Taxes, although many people in retirement will have to report at least a portion of their Social Security income on their tax return, many people, it's still treated more preferentially than other income, such as a traditional IRA, where you take $1 out of a traditional IRA, you got to report that as income on your tax return. And then obviously income, it's a guaranteed income stream. So Social Security is for all the people talking about the solvency of the system, the Social Security benefit is a big, big factor in the success of someone's retirement income plan. So let's talk about the fundamentals, and then we're going to wrap up our discussion talking about the 5 things you need to know. So let's just cover the highlights of Social Security. Okay, what gets you in? What makes you eligible? Well, it's 10 years of work, right? 40 quarters of work, right? So you got to be working for at least 10 years to get in the game. how do you pay for Social Security benefits, right? Or how do we pay? They're individual contributions, and you pay those through a Social Security payroll tax of 6.2% on your first roughly $118,000 in earnings. So if you earn more than that in terms of salary and wages, you stop paying that once you get to that level. By the way, your employer is also making contributions as well. Benefits. Benefits are calculated based on average monthly earnings indexed for inflation. So roughly, what does that mean? It means roughly that what the Social Security Administration is going to do is going to look at your work history, okay? Assuming you're eligible, they're going to take your top 35 years, and they're going to apply that into their formula. So, for some people, some of those, there might be zeros if especially for maybe working mothers who took some time off to have kids, they may have some zeros in there that would be averaged in. So you take your top 35. Retirement age, for people retiring now, it's 66. For people who are retiring who are born in the 60s or later, your full retirement age is 67. And you can take it early, right? You can take it at 62, but you're going to receive decreased benefits, or you can wait up to age 70, and we're going to talk about that in a little bit more detail, and your benefit amount will actually go up and pretty significantly. And then lastly, spousal, and I should put in there survivor benefits, right? Spousal benefits, spouses can receive up to 50% of their working spouse's amount. And the survivor benefit, you can receive up to 100% of your spouse's benefit. So that's it in a nutshell, I think the fundamental building blocks. And now what we're going to do is we're going to talk about the 5 things we think you really need to know. And the first, and this might be the most important, it might pay to delay. And I should say it does. I should say it does pay to delay, because the reality is roughly 3/4 of the people take Social Security early, and not just early. They're taking it almost at the single point at the earliest they can, which is age 62. So people have this. I think they have this mindset that when they're eligible for Social Security, their mindset is often, I better take it while it's still there. And I do think that's the wrong mindset to have, okay? Because they end up locking in a much lower lifetime benefit. People often underestimate their life expectancy, right? And for some people, obviously, taking it at age 62, for people that are really pressed for income, they might not have any other choice. So I certainly understand that. Some other things to think about, too, is if you are prior to your retirement age, and we'll use 66 for our purposes tonight, but if you take it prior to 66 and you're still working, earning wages, then the earnings test may apply. And what the earning test says that if you make over a certain amount, they're going to withhold a certain portion of your Social Security benefits. So roughly, if you make over, let's just call it rounded off to $15,000, for every $2 of earnings, $1 of your Social Security benefit is going to be withheld. Now you're not going to lose that on your own benefit for good. It's going to be for your own retirement benefit. It's going to be factored back in when you reach age 66. But so for people who are still working, it typically doesn't make sense to take that early. And then in most cases, you can't change your mind after benefits begin. So you can change your mind, but only within the 12-month period. So there didn't used to be that 12-month rule, and the government you could change your mind 3 years later and pay back the government and reset your benefit. You can't do that anymore unless it's just within a 12-month period. So it's important that you get it right out of the gate. Now the big benefit, of course. Think about every year that you delay, you're going to get an 8% raise. Now you're giving up the use of that money, but a guaranteed 8% increase every year that you wait up to age 70. By the way, that is a significant amount. Obviously, in this market environment, in this interest rate environment, we'd like to get a guaranteed 8% in anything. Heck, I'd like to get a 1% in a short-term CD, and we're certainly not seeing those types of rates. So it might pay delay. This is probably the most important message from the whole conversation tonight. And as you see, here's an example, right? Someone earning roughly $75,000 in earnings across their working years. This is what their monthly check is going to look like at age 62, at age 66, and finally at age 70. So almost double the amount if you wait until age 70, the way the math works there. Now, of course, the thought process here is obviously health, and if someone absolutely knows that their life expectancy is going to be significantly shorter, obviously that's an important factor that comes into play. So let me jump ahead a little bit, and let me talk about the second point, and that point talking about planning for your surviving spouse. So for those of you that are married, what you need to do is think about Social Security as a joint benefit and not just as two single benefits. And historically, this has been a big problem for married couples, meaning that the higher earning spouses, and there's been a few studies on this, have taken Social Security early. And what they've done is they've locked in a lower survivor benefit for their spouse, the rest of their spouse's life. So I think for married couples, the way you should approach Social Security, if you can, again, if you don't don't need immediate access to your monthly check, is think about Social Security as longevity protection for whichever spouse is going to live the longest. So to what extent you can, you want to maximize the monthly check of so that the monthly survivor check of the last remaining spouse. I think that's the way you think about it. Think about it in terms of joint life expectancy, and what historic study was done that showed that the main wage earners. This was a study about 10 years ago or so, but in those demographics, it was typically the men took Social Security early at age 62 or 63, not thinking that they locked in a low survivor benefit for their wife, for their wife that could potentially live to be in their mid-90s or even older. So that was a big issue. And we're going to talk about over the next. It's a little confusing, but spouses also have benefits because they can consider dual strategies. And it's a little difficult. I do a lot of these client events in person where maybe it's a little bit easier than in a webinar and conference call type of format. But let me give it a shot here and talk about these dual strategies. So there's two in particular. The first being, and it's probably hard to read this slide, but I'll explain it. The first is called, I'm going to talk about file and suspend, and I'm going to talk about restricted application. So let me talk about file and suspend, okay? And Justin and the team, they can certainly follow up with if you contact them, they can send you these slides afterwards, so you can look at them and print them out if you want to. But file and suspend is a good strategy. Think about a couple that has one high earner and the other spouse is a low earner or maybe didn't make enough to be eligible for Social Security benefits. And in this type of situation, how the strategy works is the highest earner waits till their full retirement age before they file for benefits. So let's call it age 66, okay? Now, what they do is they file for benefits at age 66 and immediately suspend them. So that doesn't seem to make any sense. Why do you immediately suspend them? Well, by filing for your Social Security benefit, that triggers the spousal benefit. So spouses can't get benefits unless their working spouse has filed for their own benefit. So the higher earner files for their own benefit, and that turns on the spousal benefit. Now, they immediately suspend, meaning that they're not going to get their monthly check, and instead, their amount is going to grow 8% each year until they turn 70, for example. So they're letting the highest earners letting their own check grow by the maximum amount, hopefully. Now, what happens is while that's happening, the other spouse is eligible for spousal benefits. So as long as the other spouse is age 62 or above, now the other spouse can receive spousal benefits, while the highest earner is letting their own benefit grow, again, at least or at most up to age 70 with an 8% raise every single year. So what happens at age 70 is the highest earner takes their benefit, their monthly amount. That's the biggest check they could possibly receive. And even if they pass away, that surviving spouse is going to be guaranteed the highest monthly check for the rest of his or her life.
Thank you.
So that's a good benefit. That's a good strategy to think about if you have those couples that you have a high earning spouse and then a no or low earning spouse. Similar strategy with what we call restricted application. And of course, you can Google these on the internet and get. There's a lot of articles about this out there. But a restricted application, this is a similar type of strategy for married couples, and it applies in situations where maybe they're both too good earners. So in this case, the older spouse or the higher earning spouse gets to full retirement age. And restricts their application to spousal benefits only. You can't do this unless you can't tell the government, I just want to receive my spousal benefit and let my own benefit grow by 8% a year unless you reach full retirement age. So in this case, 66, okay? So in that case, the older or higher earner reaches age 66, tells the government, I do not want my own benefit. I want that to continue growing 8%. But I'll take the spousal benefit because their spouse had a working history and is eligible for Social Security benefits. And then same type of premise at age 70, the older or higher earning spouse turns their benefit on. They're getting their largest monthly check, and again, similar type of strategy. They've locked in the highest monthly amount for whoever's going to live the longest. So a little bit difficult on a phone call, and we're not live in a little room where we can talk this out. But certainly, at least if you get the gist of it and maybe do a little bit more research, talk to your financial advisor. These are two really good options for many married couples to think about. I'm going to go through the examples here. And then wrapping up a couple other thoughts, and again, I'll open it up for questions. There's special rules for divorced and widowed individuals. So just because you're divorced doesn't mean you can't receive benefits. You can actually receive benefits on an ex-spouse's earning record if you're currently unmarried. Again, like regular benefits, you're age 62 or older, and the marriage would have had to last 10 years or more. And your ex-spouse is eligible for Social Security benefits, so meaning that your ex-spouse has to be age 62 or over. Now, there's a little distinction here.
Sure.
If your ex-spouse hasn't filed for their own benefit, you can still get a divorced spouse benefit. So I think the Social Security realized that would be a difficult conversation for many people. One divorced spouse calling the other and saying, hey, do you mind filing for your benefit? Because I want to receive my divorced spousal benefit. I think the Social Security Administration figured that those conversations probably would be challenging at best. So you don't have to wait until your divorced spouse files. And also, I mean, I guess hypothetically this could happen. You might have been married to multiple spouses for 10 years or more. You can actually pick and choose which one you want to receive the benefits on based on whoever has the highest earnings record, with the caveat that you don't have access to your divorced spouse's specific earning record through the Social Security Administration. So you sort of have to do your best guess on basically on what you think they've made over their lifetime, that type of thing. So you're not going to be able to pinpoint exactly how much you're going to receive until you receive it, because you don't have, as privacy concerns, you don't have access to their earnings record information. So that's divorced spouses. And then and also divorce, it also can be survivor benefits too. If your divorced spouse has passed away, you can receive survivor benefits based on their earnings record. So a lot of different benefits there. And then lastly, widows, obviously survivors can receive benefits. And the different thing about widows is that they don't have to wait until they're age 62. They can actually get it as early as age 60, but of course with that reduction. The longer they wait, for example, to age 66 or above, they're going to see a bigger monthly check as they wait. So that's divorced and widows. I mentioned taxes earlier. Taxes will be a concern for many people. So, for example, if you are earning between $25,000 and $34,000 in income, or $32,000 to $44,000 in that range for couples, then you may have to report up to 50% of your Social Security benefits as income, as taxable income. So it's not a 50% tax rate. You're just going to have, if you received $20,000 in Social Security benefits throughout the calendar year, you're going to have to show $10,000 as income on your return, along with any working income, retirement plan income, all the other sources of income. And then lastly, if you're over $34,000 or over $44,000 for couples, then up to 85% of those benefits will have to report it on your 1040. So I guess if I'm a glasses half full type of guy, at least it's better than, for example, taking money out of an IRA, where 100% typically of those of the IRA dollars or 401k dollars, for example, typically would be reported as taxable income. At the most, you're going to report 85% of Social Security benefits as taxable income on your return. And then the last point tonight, the impact of pension income and how that might reduce benefits. So there's a couple provisions out there, and this gets fairly complicated, but I'll cover it at a high level. And again, there's more information on the Social Security website, which is simply ssa.gov, Social Security Administration.gov, on two provisions, one called the windfall elimination provision and the other one called the government pension offset. So let's talk about windfall elimination provision. Who does this affect? And this applies to a worker who has had a job where they paid into Social Security, but maybe they're also a teacher. Teachers are a good example in at least certain states. Teachers in certain states, including Massachusetts, do not pay into Social Security, the Social Security system. They have their own pension system. So for teachers in Massachusetts, if they have another job where they did pay into Social Security and they're eligible for Social Security benefits, what they're going to see likely is a reduction in their Social Security check based on how big of a pension they're receiving, a teacher's pension they're receiving. Now, in that case, you're not going to lose your entire Social Security benefit, but you could lose a significant amount. And there's a calculator on ssa.gov that you can go to plug in some numbers to see how you might be affected. So, again, windfall elimination provision, that applies to a worker who has had a couple different jobs, one paying into the Social Security system and one, such as a teacher in many states, not paying into the Social Security system, and how that affects the Social Security check. The other one, government pension offset, impacts spouses or survivors who, again, are receiving a pension from a job where Social Security benefits were not withheld. So, for example, a teacher applying for spousal benefits in Massachusetts is one I believe of the 10 or 12 states that this applies. In that case, they would have their spousal check reduced by 2/3 of their teacher's pension income. So basically, this is a quick example. If they were receiving $900 a month from their teacher's pension, 2/3 of that is $600. Whatever they were due to receive as a spousal Social Security benefit, they would subtract $600 from that amount. So that could be fully eliminated based on how the numbers look like. So you could lose the entire spousal benefit based on your government pension there. So that does get a little bit confusing, but I wanted to cover it tonight. I know some people, more federal workers are not subject to these rules anymore, but there's still some ones dated the way the federal system used to work that they might be impacted by either one of these provisions. So that's where I'm going to leave it today. And again, Justin, I'll open it up to questions, but there are a couple of closing thoughts. I said in the beginning, it's complicated. Take some time to understand it. Don't try to get it all at once. It's going to be difficult for you. There's so many different variables, but certainly understand that it's a critical component of a retirement income plan. You're talking about over a 30-year retirement. It could mean hundreds of thousands of dollars in benefits. So it's important that you don't make any rash decisions, and especially be careful about taking it early. and work with your financial advisor to get a sense of what's your own personal situation based on, your other retirement savings and other sources of income in retirement, because they're all connected. So, Justin, I'm going to open it up for questions. I know I did receive one. We received one emailed, so maybe I'll tackle that one first, and then we'll open up, and I'm happy to stay on here and address any other questions. But a question I did. Yep, go ahead, Justin.
Thank you very much. I appreciate that. I just want to say thank you first off, and I know the intricacies of Social Security certainly can be a challenge, so the more information our clients can learn about it, the better. So thank you very much. And with that, of course, we would be happy to open the floor to our clients for any questions for Mr. Cass. Feel free either to ask over the phone, you can unmute your phone, or also via the chat on the screen. And then, Mr. Cass, I know I did send you over a question already, so if you want to go ahead and start with that. Thank you again, everyone, very much.
I'll kick off the questions. So in this particular question we had emailed ahead of time from someone who wasn't able to attend, the question had to do with implications from my future Social Security payment if I were to receive my spousal benefits before I reach full retirement age. So, for example, let's say that your full retirement age is age 66, and you want to get your spousal. What happens if you get your spousal benefits before age 66? So this is sort of confusing. But let's say you're age 63, you want to get your spousal benefit, and your full retirement age is age 66, and you've had working history. When you file for that spousal benefit, if your own benefit is higher than that spousal benefit, you're going to automatically get your own benefit in a reduced amount, obviously, because it's before 66. So you can't tell the government, before you reach your pre-age 66, you're not able to tell the government, I want my spousal benefit and I don't want to take my own benefit. The government's going to assume you're taking your own benefit unless the spousal benefit is higher than your own benefit. And again, spousal benefit is 50% of your spouse's benefit versus 100% of your own benefit. So it would have an effect. And then the other I just kind of covered, what effect, if any, would result in receipt of those benefits due to the penalty imposed on those already receiving a government pension. And I covered that, the windfall elimination provision and the government pension offset. If you are receiving a pension, again, the important, not just a pension, but it's got to be a pension from employment where you did not pay into Social Security. You didn't have Social Security payroll tax withheld while you were employed. Then that would result in a reduction in your benefit amount, either your spousal benefit amount or your own benefit amount. So I'll leave it there. Justin, any other questions before we let people get on their way tonight?
I didn't.
No, I think that's it, Bill. Thank you very much. I know we do have a chat in for the first question. Patrick was able to ask in slide 20, what is the definition of income?
Yeah, but if I got less, what was going on earlier?
For slide 20. Oh, okay. So the definition of income there, it's a little bit broader than typical income. So if you're figuring out those income levels, you take, for example, whatever you're earning. It could be bond interest or capital gains, or maybe you have a job and you're earning, you have earned income. You're also going to take half of your Social Security check or amount, your projected amount, or whatever you're receiving across the year. You're going to add that in, and then you're also going to add back tax-free municipal bond income. So that's the big difference. So tax-free municipal bonds are great, can be great options for people in higher tax brackets, obviously, because it's tax-free income. But this is the one area that I'm aware of where you have to sort of add that back in. So that does take into account municipal bond income. It does not take into account retirement income from a Roth IRA or a Roth 401k. So that's another benefit of a Roth IRA. It won't negatively impact the taxation of your Social Security benefits.
I have about 100. You want me to ask?
Thank you very much, Bill. And then the second question was just, would you mind going over slide 15 one more time?
All right, slide 15. Yeah, that's the big one. Maybe we'll look at the example example for file and suspend, and we'll sort of maybe tackle it that way because it does get a little confusing. So let's look at an example. File and suspend. Let's assume you have a husband and wife. They're the same age. They have different earnings history. The husband is eligible for Social Security, has been the prime wage earner, and let's just assume the wife was not earning much, if anything. So the husband's Social Security benefit at full retirement age is $2,500, and the wife really has little or no benefit. And the husband passes away at age 80. So the way file and suspend works is that, let's say they get to age 66, and you have to wait until your full retirement age to take advantage of this. So the husband files for his benefits and then immediately suspends. Now, because he filed for benefits, that allows the spouse to access the spousal benefit. So you can't receive a spousal benefit until the primary worker has filed for their own benefit. So now the wife is able to receive half of his benefit, and assuming she's 66. It would be a little less if she was under age 66, for example. So the husband suspends his benefit. Now what that does is that his monthly check continues to grow each year by 8%. Each year he doesn't take the benefit. So now let's fast forward to he turns 70, and now he decides he wants to receive his own benefit. Now his check is going to be $3,300 a month versus if he took it at age 66, only $2,500 a month. So he's going to start receiving at age 70. He's going to get $3,300 a month. Now his wife is going to continue to receive her spousal benefit of $1,250 a month. She took that, started taking that 4 years ago. So now their income has gone up to almost over $4,500 if you combine both those checks. Okay. Now let's fast forward 10 years. Let's say the husband passes away. Okay. Now at that point, what the wife can do, the wife can continue receiving his highest benefit that was $3,300 a month for the rest of her life. So what we've done is we've locked in the highest monthly benefit for whoever's living the longest. Who knows? She could live to be 105, and she'd be receiving $3,300 a month versus, for example, only $2,500 a month if the husband took it at age 66. So I think that's the best way I can explain that type of strategy. Justin?
Yeah, thank you very much, Bill. I appreciate it.
Super confusing, though.
Of course. So that's all the questions we have on this side. We'll leave the floor open now for a little bit and see if there's any more questions over the phone and then also over chat. I'll chime in if I see anything there.
All right.
Okay, I want to chat. But how?
Where's the chat?
And it's a chat box there?
You had it before, right?
Oh, I didn't mean to do that.
Yeah, I do have one that just came in here. Bill, what about the life expectancy of the Social Security system itself?
Sure, that's a great question. So the life expectancy of the Social Security system, the trust fund will be exhausted, according to the latest reports, and this changes every year, but in 2033, the Social Security Trust Fund will be exhausted. And these are all projected numbers, so we're not dealing in, it's not like there's a bunch of cash in a vault somewhere sitting in Washington somewhere. But these are all bookmarking entries. So what that means that if the government doesn't do anything, and that's even the government, I'll give them a little bit of credit that I think they will move before that. If they didn't do anything, once we get to 2033, it wouldn't mean that you wouldn't receive anything. You would still, without them doing anything, you would still receive 75 cents of every dollar you were supposed to receive. So, that's not great, obviously, but it's not like you wouldn't receive anything. And the government I think the good news is that the government, I believe, will take action on this. And it's not really a monumentally difficult math problem. It's a troubling or challenging political problem. And it's big. I know, big surprise talking to people that are, in and around the Beltway around D.C. But if you tweak the Social Security system a little bit here and there, then you can buy yourself decades worth of solvency. So, for example, and again, most likely the effect would be on people that are under age 55 currently, for the most part. So, for example, the retirement age would probably be inched up a little bit. I was born in the 60s. My retirement age is age 67. That might go to 68. Another thing that they'll probably do is you pay Social Security payroll tax up to about your first $118,000 of earnings. That'll probably go up. You'll pay more. You'll continue to pay that payroll tax probably up into, let's call it $150,000 of income, or maybe even $180,000 of income. So I think that will happen. It's just reality. We don't want to be paying more in taxes, but that's what's going to happen. And then one of the other areas, and these aren't the only ones, but here's some of the examples. For people in Social Security, their cost of living adjustment will be scaled back a little bit. They'll use a different formula that is not as, I guess you could say it's not as generous. So it's not going to be a huge difference, but if you're talking about tens of millions of people receiving Social Security, even a little difference across all those people can make a bigger difference to the whole trust fund. So that's my answer to the future Social Security system. By the way, Social Security, again, I think it's much more difficult to attack the Medicare problem than it is the Social Security problem, just as an aside.
Thank you, Bill. We do have another question in here in regards to pension information. The question is, does a spouse that works for the federal government that is under the CSRS get any spousal benefit from the spouse that is eligible for Social Security?
You sort of cut off in the beginning of that one.
Let me just repeat the question again. So it is a pension-related federal government question. The question is, does a spouse that worked for the federal government and is under the CSRS system get any spousal benefit from the spouse that is eligible for Social Security?
Well, it depends. I think you'd have to check. Your best bet is to check with your employer, because they probably have gotten this question or not. But my understanding with federal employees is that, for the most part, Social Security benefits, that they're part of the Social Security system. Years ago, they weren't. So depending on the when they were employed, there might be an impact. But I believe that now that most federal employees are part of the Social Security system. So if they're getting payroll tax withheld, they're not going to see any issue with the amount that they receive as a spousal benefit or on their own benefit with regards to their pension income. Typically, the people that are impacted are typically, again, those municipal employees in roughly a quarter of the states out there. So it could be, teachers are, again, the biggest example of this probably, but other municipal employees like firemen, police, that type of thing that are on a separate pension system outside of Social Security. So, but I don't know this specifically for this federal government agency or this employer, but that's probably probably at the employer level, they've probably gotten that question before. And again, if you're getting Social Security, the easy way to tell is if it's coming out of your paycheck, you don't have to worry about that pension offset issue.
And just to piggyback on that, Bill, their client did come back in, and they basically said, I am not a part of the Social Security system. I did not pay into the Social Security system.
Okay, so then the answer is yes. Then they would be subject to the windfall elimination provision. If their spouse has for example, let's say their spouse has an earnings history and is receiving their own benefit, then their spouse wouldn't affect their spouse's ability to get their own Social Security. I guess if it's put that way, it affects a worker who's also receiving a government pension where they weren't part of the Social Security system, or a spouse whose own job they didn't pay in the Social Security system, if that makes sense. And as I said, there's a pretty good write-up. There's a couple brochures out there. If you Google those, the windfall elimination provision or government pension offset, and you just you go to the Social Security website, SSA.gov, or just Google it, and there's two brochures out there that explain in more detail how these work. Confusing, though. Again, surprising, though. that a government
Thank
program
you
would be
very, very much, Bill, for that tip. I certainly appreciate it. And I hope that did answer all the questions. We know we did have some great presentation comments in the chat box as well. So I hope everyone did, and of course, get a lot out of this. But we'll continue to keep the floor open here for a little bit for questions.
And Justin, too,
yeah.
if someone thinks of a question after,
sure.
like let's say they get to tomorrow, okay, and they think, oh, geez, I wish I would ask that question. Justin, just have them reach out to you, and obviously you have my email. You can connect with me, and we can certainly follow up.
Yes,
know that.
absolutely.
He didn't know.
Wasn't sure?
Mm-mm.
Yeah, absolutely. And anybody that does want any further information for the presentation, any questions, like Bill said, feel free to reach out to me, and we can certainly reach out for more information from there. And again, Bill, I'll just keep the phone down for a minute and see if there's any other questions.
Hello. Hello?
Yes, we can hear you.
Hello?
Yes, sir, we can hear you. You can go ahead and state your name and ask your question if you'd like.
This is Frank Solomon. I joined in about 15 minutes afterwards, but when I joined in, there was Bill was talking about the divorced spouse who could file for his own Social Security if they've been married for 10 years before the divorce. And does that apply when the other party, who's the benefactor in the sense that let me finish it, please. Does it matter if the other spouse is remarried? Say if I and my ex-wife were divorced, we've been married for 10 years, and then I or she remarried, and then I file for spousal benefit. Does it matter?
Yep, Frank. Yeah, yes, it doesn't matter. So you could actually have. Let's say you had a individual that had had an ex-wife and has a current wife. You could actually have both of them receiving spousal benefits based on his one earnings record. So his divorced spouse could receive a spousal benefit, right, if they met those requirements, and his own currently married spouse could receive benefits, and neither would impact the other.
Oh. What about to the central figure, the one who's the ultimate factor himself?
No, there wouldn't be any, there wouldn't be any impact on that. So you could have, you could have, I guess that you would be limited, but you could presumably have 3 different ex-spouses if you're married to all of them for 10 years or more. Probably not likely that would happen, but they could all be receiving benefits independent of one another, and that wouldn't have any impact on that one husband's own benefit that he had 3 ex-wives receiving all these benefits.
And regardless of their marital status of the current...
Exactly.
Thank you so much.
Yep.
And thank you for the question, Mr. Solomon.
Thank you.
Bring the crackers over.
Right. Well, we'll leave it open for another second here, but Bill, thank you very much. I know the client certainly enjoyed the information, and thank you, everyone, for joining tonight. We certainly find these webinars very beneficial, and I hope you did as well. So, Bill, I can leave it up to you then for closing remarks, and if we have any other last-minute questions.
Like I said, if you have a question after the fact, certainly just reach out to Justin or the team, and I can certainly respond via email or follow up with folks as well if they have any questions. But good luck out there. Get educated, ask for advice, and again, I guess a delay if possible. If I could leave you with that one thought, and probably most importantly, especially from all of us in the Northeast who had an awful winter, enjoy the rest of the summer. All right.
And thank you again, Bill. And thank you, everyone. Have a great evening. Goodbye.